Lemonade reported earnings yesterday and the stock went down massively. It is down over 10% right now. Hello everyone, welcome back to your channel. Today we are going to talk about Lemonade stock, ticker symbol LMND, their earnings call, their expectations and everything. I was going to post this video last night, but their earnings call was this morning at 8 a.m. 2 hours ago, so I needed to listen to that before the video. If you're new to my channel, please consider subscribing and smashing that like button since it really helps the channel out. Okay, so first of all, in their shareholders letter, we can see that their in-force premium went up 91% year over year. As you can see here, it has been going up since 2019, which is always nice to see. Their premium per customer is up 29% as more and more people are bundling up their products and adding more products to their insurance policy. And total customers is up 48% year over year to 1.2 million customers. Now, we can see that their gross loss ratio is 7% points year over year up, as it was 67% quarter to 2020 and it is at 74 right now. We do know that it went up massively to 100 and something percent because of what happened in Texas, the Texas freeze in quarter one, and then it started dropping again. It got better to 74%. I do understand that it's higher than a year ago, but they did say in their earnings call that even though the Texas freeze is over, thank God, by adding more and more products, it gets expensier, as they do with their pet insurance, life insurance, because before they only had 2 products and right now they already have 4 and almost 5 with the car insurance. We do see that their gross earned premium is up 90% to $67 million. It is very important to notice that their gross earned premium is up 90% and their in-force premium is up 91%, and later we're going to see why. They did saw an acceleration in in-force premium growth for the second consecutive quarter. Separately, for the 4th consecutive quarter, we saw accelerating growth in premium per customer, reflects the sustained diversification of our business mix to higher premium products, which is what I said, is not people paying more for their policies, it's people adding more products to their policies. So maybe they started with renter's insurance and now they have a pet insurance or a life insurance. So the premium per customer increases because of that and not because Lemonade is increasing their premium. Now, the Lemonade card is their latest product that they came out last quarter with, but it's not available yet. We are in a waiting list right now. I am in a waiting list right now. They have not launched this product yet, but even though one of the questions in the earnings call was when is this product going to be launched, because as you can see here, they said that we are not at this stage announcing a concrete launch date, nor are we including anticipated IFP, in-force premium, associated with Lemonade card in our guidance for full year 2021, because as they said in their earnings call, it's not because of them, it's because of regulators. Even though if they would like to launch this product tomorrow, they can't, because they have to go state by state getting approved by regulators, and that's out of their control. Now, their product mix, as I said, they already have 4 products right now. That's why renters right now represents 50% of their business, and it went down from 71%. It's not because they are leaving, it is because, as they said here, they enable the shifting mix of first-time Lemonade customers to higher premium products, pet, home, life. Last year, they only had 2 products, and right now they have the renter's insurance, pet insurance, home insurance, and life insurance. So obviously, the IFP breakdown is decreasing. For renters, it's now 56%, homeowners is 30%, pets 13%, and life is 1%. So it doesn't mean that the company is declining right now and it's going to go bankrupt. No, they are still growing massively year over year. Now, their geographic mix, as you guys know, there is already at least 1 product available in the all 50 states of the United States of America, and they are already abroad in about 2 or 3 Europe countries, but they are looking to expand even more. As you can see here, we recently made meaningful progress in pursuit of this goal with the launch of our renter's insurance product in Florida, which I think it's incredible because I'm from Florida. I used to live in Miami, and I know and I have seen all the buildings that they are constructing right now. They're only for rent and not for people to buy apartments. So all those people are going to rent those apartments are going to need a renter's insurance. And I think that it is a good market for them to target. As they said, Florida, renters insurance market in Florida is the fourth largest in the nation as measured by total gross written premium. But we do have to take into consideration that by first touching on renters insurance in Florida, we will be able to fine-tune our approach in a risk cat state before we develop our homeowners product there. We look forward to bringing a limited renters experience to Floridians and anticipate our product suite in the state will expand over time. Internationally, they are doing very good. As you can see here, they have been getting a lot of awards, 5-star for best product quality on MoneyView Research and Dutch rating company for insurers, best product with a score of 9.3, best score for a detailed service offering in German Financial Review publication. Now, this is something very important, the reinsurance renewal and loss ratio. But it's something that we're going to talk about later. First, let's go and see their revenue. Okay, as we can see here, their revenue, their total revenue went down to $28.2 million from $29.9 million year over year, which obviously seems awful, but it's not true. Last year in quarter 2, 2020, they did not have reinsurers, meaning that right now they are ceding 75% of their premium to reinsurers and they're only keeping 25% of their premiums. That is why we cannot compare their revenue nor any of their financials to quarter 2, 2020. We have to start comparing in quarter 3 and quarter 4 from 2020 as they started with reinsurers in July 1st of 2020. So obviously a lot of people is talking about this, have always talked about this every single quarter that they report earnings, and I've always told you guys that you can't compare these numbers. Now I do understand as well that their expenses have increased a lot. 33 million from sales and marketing all the way up from $16 million, 14 million all the way up from 4 million in technology development, and 15 million all the way up from 5 million in general administrative. But as I said here, they only had 2 products in quarter 2 2020. Right now they have 4 or 5. Obviously they would need more technology, more people working in the offices or general administrative, more marketing to start launching those products and make people learn and know about their new products. So this is not something to be concerned right now. I do want to wait to see their third quarter as we will be able to finally compare with 2020 as now they will have reinsurers in quarter 3 2021 in comparison to quarter 3 2020. That is why, as they said here, we agreed to cede 75% of our premium to a panel of partners, thus retaining 25% of the risk on our own balance sheet. That's what I was just talking about the reinsurance renewal and loss ratio. Our reinsurance partners, of course, are for-profit institutions, and more reinsurance ultimately means more cost. This is something I like. Therefore, as our business grows and diversifies, lowering our book's volatility, we plan to gradually reduce the portion of premium that we cede over time. This is good because we're going to see more premium coming in the company and not going to reinsurers, but obviously they have to understand the risks that they are able to take and not overpass that. Now, their in-force premium, a lot of people have asked me what is the in-force premium. As you can see here, which is way better explanation, the in-force premium is the multiplication of customers times premium per customers. So if they have 1.2 million customers with a premium per customer on average of 246, that means that they have an in-force premium of 296.8. That's why, in my opinion, we need to compare their in-force premium year over year and their gross earned premium year over year, which has grown 90% and 91% for the business. And that's something that they also talked about in their earnings call. As we can't compare the revenue with 2020, we should compare the in-force premium and the gross earned premium, and obviously the total customers, as that shows if the company is growing or not. Now, for the quarter 3 2021 guidance, we can see that for quarter 3 they are expecting an in-force premium of 336 to 339 million, a gross earned premium of 76.5 to 77.5. Remember that they had a premium of 297 million, and 67 million for gross earned premium. And revenue of $32.5 million to $33.5 million, adjusted EBITDA loss of 55 to 52 million, stock-based compensation expense approximately 15 million, and capital expenditures of approximately $3 million. Now, something I want to compare is that they are expecting a revenue of 32.5 million to 33.5 million. If we do want to compare the revenue, finally, we will be able to do it in Q3 because of the reinsurers that I was talking about. Last year, as you can see here, 3 months ended on September 30th, they reported a revenue of $17.8 million. That's why we saw a decrease because of the reinsurance. But in comparison to 2020, which is when they started with reinsurers in 2020, they had a revenue of $17.8 million. So revenue of $32.5 to $33.5 million is actually a nice growth. We do have to take into consideration that they increased their guidance once again full 2021, which is a very good sign. For the whole 2021, in-force premium December of 380 to 384, gross earned premium of 286 to 288 million, revenue of 123 to 125 million, adjusted EBITDA loss of 173 to 169 million dollars, stock-based compensation expenses of approximately 50 million, and capital expenditure of approximately 11 million dollars. You guys know that I like Lemonade a lot. I've been investing in them since last year. Let's see exactly when. I started investing on September 1st when the stock was at $55.70 per share. Then I bought again at $49 and at $49. That's why I have an average price of $56.74 per share. And even though the stock is down 12%, I'm up 38.91% in my position. Obviously not the same as that 100% that I used to be when the stock went up massively, but I'm still up and I still see potential in this company. So I'm not thinking about selling this stock anytime soon. I do want to see their Q3 as we will be able to finally compare it directly with the revenue of Q3 2020. But I do believe that the company is still accelerating its growth. It's still expanding internationally and nationally. They are creating new products. I do understand that they are disrupting a very difficult industry, but I do believe that they are able to do it with the technology that they have. We're gonna wait and see in the long term, but right now I'm very happy with my position. If it goes down below, I don't know, 70, maybe $65, I would add to this position. I don't see it getting back to 50, but we never know. It got there in February. Hope you enjoyed the video. Thank you for watching and see you next time.